Hi, I'm Jamsi. I'm a finance professor and welcome to another video. So for today's video, we will be wrapping up our mortgage market series. I'm so sorry about that. With a short discussion on the secondary mortgage and the participants in the mortgage markets. So in the last three videos, we talked about what the mortgage market is, who it caters to, what it does, and how it's different from your usual capital market transactions. What are the different types of mortgage, the characteristics, and even the amortization of a mortgage. We went through it in the last three videos. So to round out our discussion, we move forward with a discussion of the secondary mortgage markets because in the past, we have been focusing on the primary mortgage markets, meaning individuals transacting or dealing with lending companies or mortgage companies. What happens then in the secondary mortgage markets? So let's find out. So how does the secondary mortgage market work? So in the secondary mortgage markets, the loan originators, meaning those who approve or work on our mortgage applications, such as the banks and other mortgage companies, also operate in the secondary mortgage markets using two ways. First is the pooling of mortgages. So when we say pooling of mortgages, we mean grouping of recently originated or approved mortgages and selling them in the secondary market. And second is the securitization of mortgage, which was discussed at length in the first part of this four-part video series. So both of these methods actually allow for the reduction of liquidity risk, interest rate risk, default risk, and credit risk from the side of the banks. Because by passing on the risks and selling them to other parties, we essentially remove these originated mortgages in the books. In the previous chapters, we have discussed how banks make money out of mostly short-term deposits because essentially we, the depositors, actually go to the bank, deposit our money, and in substance, we actually tell them, hey, I have extra cash. You may use my extra cash and make more money out of it, but as payment for lending you the money, give me a portion of your profits. And that's how we depositors end up getting interests. So, how do this mechanism help us make money and talk about it in terms of the mortgage markets? So, what happens here is that if these mortgage companies rather and banks would rather end up hanging on to these particular newly originated mortgages, in their books, essentially you expose yourself from the risks of changing interest rates because, of course, the interest rates that we agree today may not be the same as the interest rates tomorrow or in the next 3 years. And because of these fluctuations, there might be corresponding losses that would be incurred or experienced by the mortgage companies. So, this is why these mortgage firms or these banks would rather sell off or pass the risk of these mortgages through pooling and securitization. In the same way that banks would rather invest their depositors' money on short-term deposits rather than choose to keep it with long-term deposits or long-term investments. Now, when the mortgage companies and banks pass on the risk of these mortgages through pooling or mortgage-backed securities through securitization, they now act as servicers and collecting agents on behalf of the secondary investors, as was mentioned in the first video. Also, financial institutions have sold mortgages and real estate property loans among themselves for a long time. A large part of correspondent banking, meaning a large bank who provides a small bank a number of deposit, lending, and other services, has also been prevalent. So what do this mean? What does this mean, rather? So it means that among themselves, they can actually agree to buy off one another's newly originated mortgages. And in the secondary market, it is usually where these mortgage sales happen. So it is when a financial institution decides to sell an originated loan with or without recourse to an outside buyer. So in accounting, we often hear the words with recourse or without recourse. So let's refresh our memories for a little bit. Recourse is the ability of a loan buyer to sell back the loan to the originator should it go bad. So, if the loan is sold without recourse, the originator, in this case the banks and the mortgage companies, completely removes or write-offs the loan entirely from their books and will no longer have the liability to these mortgages. In comparison, when a loan is sold with recourse, the originator, meaning the banks and mortgage companies, will retain a contingent risk credit liability. All right. So in accounting, we often hear the term with or without recourse when we're talking about receivables. So it also applies here in the secondary mortgage where the financial institution can actually sell off these mortgages at a with recourse or sans recourse basis. So why did or why was the secondary mortgage market created? So this secondary market for mortgages was created to boost the economy during the Great Depression and to increase the liquidity in the mortgage market and the availability of affordable housing. So that is why the US has a secondary mortgage market to boost the economy and to ensure that there was available housing that was affordable and could be managed by your ordinary and your average Jills and Joes. The Federal National Mortgage Association, or otherwise known as Fannie Mae, was established to buy mortgages from financial institutions so they could lend to other mortgage borrowers. So in effect, Fannie Mae acted as a buyer from these mortgage companies so that these mortgage companies can keep their shops open and continue to underwrite new business. All right? So the mandate of Fannie Mae was to act as a secondary mortgage facility so that, as mentioned, it could buy, hold, and sell mortgage loans. So as was discussed or as was mentioned, Fannie Mae is a U.S. federal agency that will act as a secondary mortgage market facility and can purchase, hold, and sell mortgage loans. So Fannie Mae grew very large over the years and have acquired a lot of debt because essentially it buys from these mortgage companies and sells them to third parties. So because of this practice, of course, at some point they would have acquired a lot of debt. And so for that large amount of debt to be removed from its balance sheet, it became a publicly traded company. So that is the history of Fannie Mae within the US mortgage markets. But in the 1960s, another girl came along. And I am talking about the Government National Mortgage Association, or fondly known to the Americans as Ginnie Mae. And Ginnie Mae addressed the decline of availed VA guaranteed home mortgages, as well as the Federal Home Loan Mortgage Association. So this is actually Freddie Mac. So Ginnie Mae was actually a government counterpart that focused on ensuring that the veterans or the retired military men and women of the U.S. Armed Forces was able to avail of a guaranteed home mortgage from the U.S. government. So, unlike Fannie Mae, Ginnie Mae is a government-owned enterprise. And Freddie Mac is also actually a government-sponsored enterprise like Fannie Mae. So those are two different things. So Ginnie Mae is owned and controlled by the government, while Fannie Mae and Freddie Mac are actually agencies that have the support of the government. So, within the secondary mortgage markets, the Federal Housing Authority, or the FHA, was also established for the Veterans Association or the Veterans Administration to ensure certain mortgages against default risk and thus making it easier to securitize mortgage-backed security. So that's a lot of institutions that were put in place to ensure that the secondary mortgage market in the US would actually remain in place and will remain strong. So, in that regard, let's talk about the different mortgage-backed securities. So, as was mentioned in the first part of this four-part series, there is a practice within the mortgage markets to actually engage in the securitization of mortgage through the issuance of MBS or the mortgage-backed securities. Now, these mortgage-backed securities allow mortgage issuers, meaning the financial institutions and the mortgage companies, to separate credit risk exposure from the lending process itself, moving from the traditional model of originating and holding the loan or the mortgage to maturity to the originate and distribute model. So as was mentioned, the goal of the mortgage-backed security is to actually remove the risk from the banks and the lending companies that is associated to the business of mortgages. So to ensure that their business lives on for a long time, they have to remove that level of risk and pass it on to secondary investors in the form of mortgage-backed securities, essentially moving themselves out of the traditional process the loan and hold it through maturity to the newer model, which is originating the loan or processing the loan till approval and then distributing the risk through mortgage-backed securities. So, what are the different types of mortgage-backed securities? So, there are three. First, we have the pass-through securities. These securities pass through promised payments of principal and interest from financial institutions to secondary market investors. So if a secondary market investor actually is holding on to a pass-through security, it means that the income that the secondary market investor receives come directly from the owner of the home. And as they make their payments as collected by the financial institutions, the financial institutions will then collect it in behalf of the secondary market investors and distribute it to them. So that is the essence of the pass-through security. And when does this happen? So after a mortgage is accepted, it is being pulled. So we have mentioned in the previous slide that in the secondary mortgage market, pooling of securities or pooling of mortgages is a common practice. So once a mortgage is approved, it is then pulled together or grouped together with other similar mortgages and sells interests in this pool to secondary market investor. So The more security that an investor holds represent a fractional ownership of this pool of mortgages. So, all right, that is the pass-through securities. Second, there is what we call the collateralized mortgage obligations. So, collateralized mortgage obligations are mortgage-backed bonds issued in multiple tranches. So, a CMO is a multi-class pass-through security. So, if your pass-through security is just your average piece of investment belonging to a single class, your CMO could probably be composed of securities that come from different pools of mortgage and combined together into one bond. Depending on the class of the CMO, the bond holder receives a guaranteed rate that is paid semi-annually. So if you think about it this way, the pass-through security is basically a bond coming from one pool of mortgages with the same level of risk, with the same characteristic. A collateralized mortgage obligation is a bond that has a backing from these different, that has backing or that has guarantee from different pools of these mortgages. So it means different characteristics, different levels of risk, different interest levels, and whatnot. So they combine it together to form one bond, and that's how you get the CMO. So the most common mortgage-backed security that is being used is the mortgage-backed bonds or the asset-backed bonds, which is what was discussed at the beginning of our mortgage market series. And these mortgage-backed bonds are used to raise long-term, low-cost funds collateralized by a pool of assets. So, unlike pass-through securities and collateralized mortgage obligations, the mortgage-backed bonds normally remain on a firm's or a financial institution's balance sheet. Secondly, mortgage-backed bonds are collateralized assets, meaning the cash flow on the mortgage backing the bonds are not necessarily directed to interest and principal payments on the mortgage-backed bonds, but to a specific piece of the property. So meaning if you are holding on to a mortgage-backed bonds, you are actually entitled to a segment or a portion of the financial institution's specific asset. That's the difference between pass-through securities, collateralized mortgage obligations, and mortgage-backed bonds. Now, to cap off our discussion of the mortgage markets, we move forward to the discussion of the participants in the mortgage markets. So, we now take a look at the different participants in the mortgage markets. And there are quite a few. So let's take a look at each one and see how these individuals and institutions play a role in the mortgage markets. So, first mortgage market participant is the mortgage pool. These mortgage pools, as was discussed in the previous slides, are necessary because these facilitate the creation of the different mortgage-backed securities that can be sold within the mortgage markets to interested participants. Second are the depository institutions. Of course, these are your banks because they are also serving as facilitators of the mortgage or the mortgage originators. Third, life insurance companies because these life insurance companies, apart from investing in the mortgage markets as well, a portion of the cash that their policyholders pay in premiums, they also actually participate in the form of property mortgage insurance. The same is true for mortgage companies because, like your financial institutions, your mortgage companies serve as facilitators or originators of the mortgage, as well as your other financial institutions, including other insurance companies, pension funds, and REITs, who, like the life insurance companies, would often invest their excess cash in the money markets through mortgage-backed securities and the likes. And of course, last but not the least, we have the households, the businesses, and the government units. Of course, the households and businesses are the top customers or the top issuers in the mortgage markets because they are the ones who are usually applying for these mortgages, and the government units are actually there to support and to ensure that the operations of the money markets are free from intervention and that the system is fairly strengthened. And that, ladies and gentlemen, ends the final video on the mortgage market discussions. So I hope you learned something from me, and I will see you on the next one. Toodles!